So I'm sure you guys have experienced this before. You're watching a particular stock or an ETF or an index fund and you want to buy it, right? But you keep watching that stock and the price keeps going up and it's going up and up and up. And eventually you say, you know what, I'm going to buy it now because the price is probably going to keep going up. And then once you actually buy that stock or that ETF, like a minute, an hour, maybe a couple hours after, maybe even the next day or the next week, you'll see the reports that stocks are pulling back or that particular stock or company that you just invested in is pulling back and the stock nosedive. Now, I'm also pretty sure that this has happened to you multiple times before when you're not looking at the stocks or the ETFs. Like when you're paying zero attention, they're pretty much just moving sideways. They're either going down or they just go sideways. And then once you start paying attention to something that you actually want to invest in, the price starts going up, and then no matter how you try to time it or no matter how much you watch the news, you read up on this particular company or stock and you try to time it, as soon as you purchase that stock, whether it's moving sideways or going up, it's immediately going to go down. And in this video, I'm going to explain to you a little bit deeper than the surface level of what I just found out about why stocks go down right after you purchase them. Now, I know this can be a really annoying thing when you're investing because some people do like their technical analysis, some people do like analysis of the companies, and it really doesn't matter what you do. When you buy stocks, they always, for the most part, go down. Now, eventually the stock will recover, it will go back up, but the point here is that once you buy it, it always goes down right after. And the most obvious answer here as to the reason why this happens is because of the market, right? You can blame the market. This goes back to the law of supply and demand. So you could argue that if the stock is falling, then most likely a lot of people are selling. If the stock is going up, then most likely a lot of people are buying it. And yes, that is one factor, but there's much more to it than that. And it's actually a lot more complicated than this, right? In fact, what if I told you that the stock market is actually designed in such a way that when you buy a stock, it actually dips right after. So I'm going to explain and I'm going to break it down exactly how purchasing a stock works and why it always falls when you buy it, and also what brokerages and banks have to do with it. And by the end of this video, you're going to have a clear understanding of probably a lot of stuff that you didn't know about if you're an investor. And before I get into that, just a quick reminder, if you are new to the channel, my name is Ian, and on this channel I talk about ways to make money, ways to save money, ways to invest your money. I talk about bank accounts, credit cards, just about everything to do with personal finance. So if you like these videos and you like these types of topics, be sure to give this video a thumbs up. I'll really appreciate it. It's 100% free. Also, be sure to subscribe with the notifications on. That way you never miss the updates of when I post new videos. And if you guys ever want to talk to me one-on-one, you can message me on Instagram. I'm leaving that link down below in the description. But let's get right back to the reason why stocks actually fall right after you purchase them. So here's how this works. When you're ready to purchase a stock, the first thing that you'll do is you'll most likely grab your phone and you go to your favorite brokerage, right? So this could be like Robinhood, for example, or Webull or M1 Finance. But you go to your favorite brokerage and you think that you're actually buying stocks on the primary market, but everything is done electronically, so you're actually buying stocks on the secondary market. However, if you were a much larger investor, let's say you had like millions or let's say billions of dollars, you wouldn't go to a brokerage like Robinhood or Webull or M1 Finance to invest in the stock market. So let's say you want to buy some stocks in Google, and let's say Google's stock price is currently $600, and you want to buy 1 million of Google stocks at $600 each. You're not going to go to your favorite brokerage to do this. Now, the reason that you won't do this is because, for example, supply and demand. So if you go to your favorite brokerage and you try to purchase 1 million Google stocks at $600 each, then this is something that's not going to go unnoticed, right? People are going to realize that there is a huge spike in Google stock on that particular day or in that particular moment. And so what is going to happen is that this is going to drive the price up of Google stock, because now people are going to be like, okay, well, the price is going up, and so more people are going to invest and the price is going to go up while you're trying to purchase your 1 million shares of Google stock. And so you're actually not going to get them at $600 per share. It's going to increase, and so you're probably going to pay like $700 or $800 per share. And similarly with selling. If you wanted to sell 1 million shares of Google stock valued at $600 each, you wouldn't want to do that on a brokerage because then it's going to potentially crash the price because everybody is going to see this huge drop and likely people will sell as well, and that will drive the price down and you may not be able to get them sold at $600 each. So if you're this big investor, you're not going to use these brokerages. What you're going to do is you're going to call up one of these big financial institutions, for example, like Goldman Sachs, and you're going to say, hey, I want to purchase 1 million shares of Google stock at $600 each. And you're going to ask them to help you out with this. Now, stick with me because this is all going to make sense and this is actually going to show you guys why stocks fall immediately after you purchase them. So let's say you walk into Goldman Sachs or you go up to Chase JP Morgan and you tell them, hey, you know what? I just want to purchase 1 million shares of Google stock at $600 each. What they're then going to do is they're going to contact other financial institutions which have huge clients and they're going to say, hey, I want to purchase 1 million Google shares right now. What is the best price that you can actually give me today based on the investors that you have that already want to sell? Now, this is what's referred to as a dark pool, and this is not really regulated or accountable, and you may have heard about dark pools before if you were watching the whole AMC situation. But pretty much a dark pool is where these large financial institutions will contact each other and try to exchange stocks so they can get the best deal possible without actually going through the market, as we all know. Now, eventually, this does show up on the stock exchanges. These transactions, they will show up. However, by the time they actually show up, you, this massive investor that has all this money and who is buying 1 million shares of Google stock, would have already settled or already purchased your 1 million stocks. So this is the main reason for having a dark pool, and this is the main purpose of dark pools. Dark pools are much more common than people think, and they're just not talked about as much. Now, this can also be referred to as non-exchange trading, and there was a report that non-exchange trading had accounted for almost 40% of all stock trades since the spring of 2017. So nearly half of US stocks trades have been done by non-exchange trading, or dark pool trading as some would refer to it as. So the dark pool is just a way where you can actually complete trades and they're not actually visible on the exchanges until everything is finalized. It's all done and over. Now, guess what else? Guess who uses dark pools? If you're guessing Robinhood, then yes, you are correct. And this is important because Robinhood is actually where most retail investors go when they want to purchase or they want to sell a stock. Now, the fact that they use dark pools isn't bad in itself, but the thing is, because these dark pools are not transparent to like the public or retail traders, then we don't know exactly what is going on behind the scenes. But we do know a couple things. And so one of the things that we actually do know is that Robinhood, for example, makes a lot of money by selling your retail trades to hedge funds. Now, here's where it gets interesting, right? Ever since the start of the stock market, retail investors, banks, hedge funds, just about everyone has always been trying to time the market in such a way where they know exactly when stock prices will go up and when they know when they'll go down. And the reason they want to do this is because if you can tell when a stock is going to go up right before it actually goes up, then guess what? You could load up, you could spend every single cent that you have and you could invest into that stock. And then if you know when the stock is going to go up, then you could also sell, or if you know when it's going to go down, then you could also sell. But it doesn't even really matter. All you need to do is to know that this one particular stock is going to go up, and then you need to know when it's going to go up. So for example, if you know that on Monday or next Monday, Tesla stock is going to go up by 6 times the price, then guess what? You can start loading up every single cent you have in your name today if you are sure, because you know that next week Monday or next week Tuesday you can sell at a 6x return. Now, unfortunately for retail investors, this is not possible, and if you actually pull this off, you're just lucky. But what if I told you that institutions, they actually know when the stocks are going to go up? I mean, this is one of the reasons why inside trading is really terrible, because if you have inside info, it's literally game over. You can buy the stocks at the right time, you can short the stocks at the right time, and you're gonna make a killing. You're always gonna make a killing in the market. Now, Robinhood and probably many other brokerages do not allow you to actually buy stocks on the open exchange, but instead, when you spend your money at Robinhood, they're actually using their dark pools and routing those transactions through the dark pools. And then when Robinhood is finished, then the transaction will appear on the stock exchanges when Robinhood actually sends it to the open exchanges. Now, I just talked about the dark pools and what they did or what the use of them is. And so Robinhood and other brokerages are actually sending your trades to hedge funds before they hit the open market. And so technically, if you think about it, hedge funds basically know what stocks are going to go up and what stocks are going to go down based on the trades and the volume of trades for each stock or ETF that they're getting from the dark pools from these different banks or financial institutions or brokerages before they hit the open exchange. So basically, in my previous example where I said, hey, if you wanted to go out there and you wanted to buy 1 million shares off Google stock at $600 and you go to like JP Morgan and they send it through the dark pool, well, guess what? The hedge funds are going to know that someone is buying 1 million shares off Google stock at $600 before everyone else or before this hits the open exchange. And even if you try to do this through like Robinhood or one of these brokerages, then the hedge funds are also going to find out. So basically, they know about the transactions before everyone else. And this is why these big institutions are already able to see what is going to happen right before in the dark pools. And so technically, if they wanted, they could short the stocks at the right time, and they could also buy the stocks at the right time. So basically, let's say you're watching Google stock and the stock keeps going up and retail investors, for some reason, just keep on buying on one particular day, or everyone is buying a lot of Google stock. Because they're using Robinhood or one of these brokerages, these trades are actually going through the dark pools and going to hedge funds and big financial institutions before they hit the open market. And so the hedge funds now realize that, hey, there's a lot of volume on this Google stock, and based on the volume they see coming in, they know that the price of Google is going to spike when this hits the open exchange. So what they could do is they could go ahead and they could purchase a lot of Google stock as well. And before it hits the open exchange, they could pull this off. And so that drives the price up. And that's right about the time when you're buying, because you've been watching Google stock for all along and you see that it keeps going up. And so you decide to throw the towel in and you purchase the stock. But guess what? Once the stock spikes and the hedge funds make their money, they're going to immediately sell. These big institutions, they're going to sell and they're going to make their profits, and the stock will temporarily tank. Now, remember, retail investors by themselves just buying individual stocks won't really do much. But for example, on Robinhood, I think you have nearly 50 million users. So just imagine a fraction of that. Let's say you have 10 million retail investors that are buying a particular stock, and hedge funds know that, for example, $50 million is going into this particular stock on any given day. Then that's an opportunity for them to purchase the stock right before it hits the open exchange, or the transaction hits the open exchange, profit, sell the stock tanks immediately after. I mean, it will recover in a couple of days, but that's how they can make some quick money. And this is the real reason why you watch the stocks and they keep going up, and then once you decide to buy it, other retail investors have been watching and they're thinking the same thing, and they buy it around the same time, and this is why the stocks crash after you buy them. This is one of the best explanations as to why stocks immediately fall right after you purchase them. Comment down below, let me know if this is something that has happened to you before, and let me know what you think about dark pools and larger institutions. Do you think that they're actually taking advantage of other people, and are they unfairly taking advantage of the market conditions for their own profits? Let me know in the comments down below. And with that said, don't forget to give the video a thumbs up if you like the content. Also, don't forget to subscribe with the notifications on so you don't miss the updates of when I post new videos. Also, if you guys want to talk to me one-on-one, you can message me on Instagram. The link is down below. But with that said, all the best with investing, and I'll see you guys very soon in the next one.